All right. I think we're good to get started. So, hey, everyone. Thanks so much for joining us for our July edition of DeFi Toronto. We've got some incredible speakers with us today. And I'm really excited about especially this first talk, which is, Mike Hathaway from who's a co-founder and, kind of a contributor to Ajna. We've also got Michael Gord, CEO of Live DeFi, who's gonna do another talk. And we're gonna try to stick to the 90 minutes today. I know we typically go over a little bit, but we'll get started with the typical agenda that we have. So we'll just kind of do a, an intro to the team. We'll go over the agenda, and then we'll kick it off with the DeFi news recap, which I know everyone usually finds quite fascinating. Before we get started, I just want to say that all of the information that is being presented here in this meetup and any others we hold in the future and any that we've had in the past is strictly for informational purposes only. Sorry, and if you don't mind just muting yourself, maybe Johnson or Victor can take care of that. And yeah, it's all just informational purposes. We're not giving anyone trading advice or anything like that. It's just for this is really just a platform to educate our community and the public at large on decentralized finance. So with that said, we'll kick it off with just a very, very brief introduction to the team. And maybe Victor, do you want to kick it off first?
Thank you. Yes, hi everyone, welcome. I used to work in the traditional finance industry, namely pension investment. I spent about over 20 years work for two of the largest Canadian pension plan. And before I fall into rabbit hole in 2014, and then I then I left the Bay Street in 2019. Just spend more time on crypto. Currently, I'm work as a crypto researcher for a hedge fund. We invest in liquid digital token. So that's a little bit about me, and pass back to Aline.
Yeah, and Johnson.
Hi everyone, my name is Jones Matthew. I work as a marketing manager at BobaCX. We're one of the few regulated crypto trading platforms here in Canada. I joined part of the DeFi Toronto organizing team about in March 2023, and it's been a good ride since then, well into this bull market. So I'm really excited to be here. Thank you all for coming, and over to you, Mark. Sorry, Ali.
Yeah, and Johnson, you look exactly like you do in your picture, which means you haven't really aged like the rest of us in crypto. So I don't know what you're doing, but you clearly have less stress than the rest of us. I'll do a quick intro for myself, and then I'll talk about
that's what happens when you don't do leverage.
Yeah. So my name is Alim Kamisa. I work for Delve. We're kind of a DeFi R&D infrastructure shop. We focus on new protocols and infrastructure for DeFi. We've built a full stack governance system called Council, and most recently we just shipped Hyperdrive to mainnet. The website is hyperdrive.box. And we're kind of in the bootstrapping phase right now, just kind of bootstrapping and growing liquidity and adding new integrations for new yield sources that we want to add to the protocol. It's basically a fixed rate, an AMM for fixed and variable yields. Very excited about it. Happy to tell anyone more about it if they have more questions a little bit later. Mark couldn't be here, but he is working with a company called Zion. They provide kind of node infrastructure, and also I think a lot of infrastructure for AI applications. Yeah, he was away today. Sophia works with ETH Global. So she's just getting back from a team offsite in France. So she was not able to be here today as well. And Imran is one of our co-founders who is now based out of Calgary. All right, with that said, we can move to the next slide. Okay, cool. So the agenda for today, we're going to start with our fascinating DeFi news recap. which is going to be done by Victor. And then I'm not sure if Johnson, if you're going to be contributing to that today, is that just Victor?
Yeah, just me.
Okay. And then we'll get into Johnson is going to be introducing our speakers. So we'll get into our first speaker, who is Mike Hathaway, who's joining us from Ajna. He's going to talk about DeFi without oracles or governance. And then we'll have a very, very short break for maybe 1 or 2 minutes to do community announcements. And then we'll get into our last speaker for today, which is Michael Gord from Life DeFi, who's going to talk about network effects and global adoption of digital assets. So with that, I will turn it back over to Victor to get into the DeFi news recap.
Thank you, Aline. Okay, so today we're going to cover main 3 topics in the news. One is that likely launch of Ether ETF next week, and then for that we're going to quickly review some of the Ethereum's performance matrix to see how Ethereum is doing so far. And secondly, we're going to talk about what if Trump got elected, what's likely what kind of policy stand they may have on cryptocurrency. And finally, there's some discussion on Uniswap, where's the token value, which I know Aline was pointed out to me and on the social media. So we're going to have a quick look on the token economics of a Uniswap token. Okay. Oh, we have a lot more people joining. Great, awesome. Okay, so both Bloomberg and Reuters has reported that the spot ETF is likely to start trading next Tuesday on July 23rd. As you know, that in late May, the listing application has been approved, but they have not approved the issuer's application. So look like they are working close to the approval, and the rumors say that they will all get approved at the same time. It's just similar to the Bitcoin ETF. They will all get approved at the same time, so that no one get jump ahead than others. So let's hope that's the case. Now let's look at the fees. Okay, so it turned out to be the number of the ETF sponsor is roughly the same. Currently, there's 10 Ether ETF sponsor, where for Bitcoin there was 11. So very, very close. And it will be interesting to look at is that how competitive is a fee. And from these 2 tables, my conclusion is that for Ether ETF, the fee are a little bit more competitive compared to Bitcoins. Why? Number one is that both 5 of them, they waive the management fee for a period of time. And for this period of time, Ether tend to have a little bit longer time period. A lot of them are 12 months, where for Bitcoin, most of them are 6 months. And also, if you look at the fee distribution, definitely Ether, the fee is a little bit lower than Bitcoin's ETF. So that's good. That means that the sponsor really want to get your business, really want people to buy. Perhaps they have to fight harder for your money now, given that a lot of money has flowed into Bitcoin ETF. So that makes sense. Okay, now, so what happened next Tuesday when the Ether ETF launched? So one interesting question is how much Ether they can buy on the exchange. So on the right-hand side, this chart shows you the red line is the number of Ether as a percentage of the total supply is currently on all the exchange. So right now it's about only 10% of the total supply on centralized exchange where you can sell for, let's say, for fiat currency. So it's not that great. So the supply is not that high. If I remember correctly, one Bitcoin ETF launch, the number of Bitcoin as a percentage of supply of all Bitcoin is roughly about 12% or 13%, so a little bit higher. So definitely we have more constraint in supply. Well, another thing which unique about Ether compared to Bitcoin is that it has smart contracts. So when you lock your token into smart contract, you cannot easily to sell. You have to follow certain conditions, certain timing, and also for proof of stake chain like Ethereum, there's a huge amount of Ether was locked in staking. Again, they could withdraw, but the number has kept going up. You can take a look at the right-hand side chart. The percentage of Ether locked in staking is keep going up. So we'll see what happened on Tuesday to see what kind of impact on the price of Ether. Here is some chart I got from the DeFi report, which just released 2 days ago, which has quite a bit good chart. So this one is showing the inflation rate of Ether is going to be slightly positive this year. And you can see that last year was negative 0.28% annualized deflation, where this year so far is slightly positive. I think the big reason caused this slightly positive inflation is two. Number one is the L2 network has been very successful. So a lot of transaction move to L2. So there's less transaction directly settled on L1 on the mainnet. Therefore, there's less burning. Number two is that, as the previous chart I showed you, that there's a lot more validator going to stake the Ether. Therefore, there's more reward, staking reward issued to the validator. Therefore, you have a little bit higher supply, new supply. So that combined these two reasons, perhaps the reason why we see a slightly positive issue. But things can change very fast, right? If the tokenization of real world asset really took off, you could imagine even at the L2, there's a lot of transaction can eventually have a settle on the mainnet, which will drive up the transaction and more Ether burning. That's possible, but we'll have to wait and see. This one, staking. So as a proof of stake chain, you can earn a staking yield. And because there's more and more people put their Ether into the staking contract, by definition, by design, the staking yield is declining, as you can see in the pink line there. So how far can it go? We don't know, but the speed of decline is slowing down because the curve is curvature is slowly, gradually decayed. Therefore, even as more and more Ether come in, the decline of the staking yield is slowing much slower. So right now, if you do decentralized staking on Lido, on Rocket Pool, you get about 3%. If you go to centralized staking platform like Coinbase, you earn a little bit less because they take a bigger chunk of profit. Or you can also go through a new platform called EtherFi, which they do staking and also restaking. So you'll earn 3% and more reward. So that's the current staking yield. As relate to the Ether ETF, as you probably heard that they all, for the approval, they all removed a staking feature. So next week, when they launch the ETF, there's no staking yield in from the ETF. However, I suspect that once becomes the Ether ETF running well, and maybe Gary Gensler left SEC, they could apply it again. They could add a new feature, and new staking could be coming back. The question is that good or bad for the network, right? Imagine you have tons of ETF that start staking, that means that the yield will keep going down, going down. Imagine that 50-60% of Ether is in staking. Would that mean that we overpay for security? We will see. Okay, next. Rise of Ether and L2 network. And this chart shows you the active user on both Ethereum mainnet and also on each of the L2 network. As you can see, the purple bar, which is the number of active user on mainnet, is pretty stable. It's not that volatile. It's about just over 10 million active user per month, where you can see that the growth of the L2 network, especially after the Duncan upgrade on March 13, and you just can see that the user just grow, exponentially. So it's very a good sign that the L2 network has did a good job attracting users. So that's very good sign. And let's look at individual L2 network, which one is doing better than others. And the top, the left-hand side, the two chart, the top is a total value lock, and you can see Arbitrum is number one, have attracted most token lock on their network. The bottom left chart show you the cost per transaction. And again, Arbitrum is the cheapest one. So not surprising that they attract a lot of value lock on their network. However, interesting happen is that we have this new L2 network, which is developed by Coinbase called Base Network. And it's get a lot of user adoption. So in terms of transaction per day, the last quarter, they actually ranked number one in terms of transaction per day. So keep eyes on Base. Unfortunately, the Base doesn't have a token. So even if you're bullish on Base, you cannot invest in it. You could buy the share of Coinbase, but not directly to buy the token, buy any token on Base network. Okay, now as you're probably aware that Donald Trump is likely going to be elected as a president later this year. Then question is, everyone's in their mind that is this good or bad for crypto industry compared to Biden administration? So far, all the sign is pointing to that under Trump, maybe the policy, U.S. policy will be more crypto friendly. Interestingly, before 2019, Trump was actually quite critical of Bitcoin and cryptocurrency. He talked about it doesn't have value. The value comes from thin air, and the crypto asset can use for facilitate for unlawful behavior. So, but somehow this year, in May, he declared that the support for crypto and talking about you want to make Bitcoin's future in US, not in China, and he will support the right to self-custody. So, and he also going to deliver a keynote in the upcoming Bitcoin 2024 conference in Nashville. So we'll see, keep your eyes open to see what he say about at the conference to get a hint what kind of policy he might implement. And then let's look at his personal holding. He actually owned about $10 million worth of crypto token. The number one holding is actually the meme coin called Trump, MAGA Trump token, which he holds almost 600,000 Trump token, which worth about almost $5 million. Then followed by Ethereum, he worth about $3 million. By the way, all the meme token he hold, there actually is on Ethereum, is issued on Ethereum. So perhaps that give him some more comfort in owning Ether. He doesn't own any Bitcoin, interestingly, but for campaign donation, Trump accept Bitcoin, Ether, and a whole bunch of other coins. So that's you can see that Trump personally has some skin in the game by owning crypto token directly. Then look at his running mate, J.D. Vance. He just announced that it was announced just last week, last few days, that he's going to do as a vice president's candidate. And he also very pro Bitcoin. He personally owned, based on his filing, he's owned about a few $100,000 worth of Bitcoin, and he voted for the SAB 121 repeal bills. For that bill, it was issued by the SEC, basically make bank harder to offer crypto custody to retail investors. So unfortunately, that bill was the vote was vetoed by Biden. So so we still have difficult. U.S. banks still have challenge to offer crypto custody under that guidance, administrative guidance. He also very critical of Gary Gensler. He thinks that the way he regulate crypto industry is stifle the innovation. And he seems, based on one of the interview I listened to it, he seems to saying that for blockchain to be very innovative, the token usually have some utility, and you shouldn't just whatever token has utility become a security, which is not good for innovation. So he seems aware that the use case of token in blockchain. And finally, he has drafted a bill that will make the U.S. regulation more crypto friendly. We'll see what happened. We don't know detail of the bill, and it has not presented for vote yet. So perhaps after the election, this bill might be present for voting. Another telltale sign of his standing on crypto is his tweet. If you remember, during the COVID, there's some trucker protests in Ottawa, and Liberal government evoked emergency act and asked bank to freeze all the bank account that has either participated in the protest or you send money donation to the protest. So he made a tweet saying that, how could you just cut off people's access to bank if you have different political view? So he seems not very pleased, and he gives that as a reason why crypto is taking off. So he seems to understand the motivation behind the crypto movement, decentralization movement. Okay, now we'll move to the last topic. Just only 2 slides. So there's people talk about what's the value, how do Uniswap token accrue value? Uniswap is the largest decentralized exchange. By all means, it's almost owning 50% of the market share. And you can see on the right-hand chart, you can see the active user and the trade count has been rising very fast, especially this year. And if you think about overall the decentralized network, decentralized ecosystem, decentralized exchange is probably the most important infrastructure for the network. But I will show you next chart. Look at the Uni tokens value, the blue line, compared to Ether. It's really has not done well. The market cap is only $5.8 billion, ranked number 20, well behind the token like Tron, behind Bitcoin Cash, behind XRP. So the question is why? What happened? But if you look at its token economic design, you can see there's some potential issue might explain why the Uni token has not performed well. Okay, So the token is capped at 1 billion token, fine. Almost similar to Bitcoin, there's a fixed cap supply. And the interesting thing is the next two feature. When you trade on Uniswap, you have to pay a transaction fee. But the transaction fee you pay is in ETH, not in Uni token. So there's no need for trader to buy Uni token, which is very different than Ethereum and Bitcoin network, where you need to buy the token, native token, in order to do transaction. The second is the transaction fee they received by the network exchange, they all pay out to the liquidity provider. None of the fee are going to the network, nor go to the unit token. And there's no, unlike Ethereum, there's no transaction fee got burned. So as a network, as the unit token holder, there's no value accrued to them. The only reason you hold a token is for voting, for government voting. So, I'm not quite understand how would the unit token accrue value, even if the Uniswap network, the exchange become very, very successful, because there's no direct economic linkage between the success of the exchange to the token value. So that's my take so far. So we'll see. My understanding is that the protocol itself, the Uniswap network protocol itself, have a fee switch. Means that if the unit token holder vote unanimously or by majority that to turn on the switch, then they could start collecting part of the transaction fee, either to the treasury, could be distributed to the unit token holder, or get burned. Either of them will accrue value to the unit token holder. Okay, so that's all I have here. I'm going to pass back to Ali.
Thank you so much, Victor. Really appreciate it. Fascinating kind of analysis as usual, covering the ETH ETF, upcoming ETF, and everything else that you covered. So thank you so much. I will actually hand it off to Johnson, who's going to do an introduction for our first speaker. And before he does that, I just wanted to say I actually met Mike for the first time at ECC this year in Brussels, just about a week or so ago. And we met at a governance gathering. Very appropriate, because he's also going to be touching on that. Yeah, he just fascinating, really, really interesting individual, and been in the space for a while. And, being one of the co-founders of one of the most important DeFi protocols, we feel honored to have him here today. So without further ado, I will pass it off to Johnson to do a formal introduction, but just wanted to thank Mike for being here today.
All right. It's my pleasure to introduce Mike Hathaway. He's a co-founder of Ajna Finance. He's a software engineer and previously worked with MakerDAO, and his team was spun off as part of the continuous decentralization process. Ajna Finance is really interesting. It's a permissionless lending protocol. It requires no governance, no oracles, immutable, fully decentralized. And I would say it's a one of a kind of protocol in itself, and truly embodies what DeFi is. So it's my pleasure to welcome Mike. Thank you for coming here and educating us all about Ajna Finance.
Awesome. Yeah, thanks for having me, and thanks for the introduction, guys. Yeah, so trying to keep this somewhat casual. If anybody has any questions, feel free to reach out in the chat, and then I'll try to answer them as we go. Like Johnson just said, I'm one of the co-founders of Ajna Finance. There's actually 9 co-founders. So we were an entire team together working at MakerDAO, and we were sort of deciding what to do as MakerDAO was decentralizing, and we decided that the coolest thing we could do would actually be to really push the boundaries of decentralization, just see just how far you could actually take it. So what we ended up creating is a fully immutable peer-to-pool lending protocol. It's secured lending, so it can use any ERC20 or any ERC721 asset as the collateral, and it can do that with no permissions, no oracles, no governance. And it really took a lot of trade-offs. So the focus of my talk today is really just how we actually were able to, like, the problems we faced, and how we were able to sort of how and why we ended up where we did. So the thing we faced back in 2021 when we were getting spun off was we were looking around at the DeFi space, and I mean, I'm not sure what the exact number was when we were doing market research back then, but currently there's around 400 different lending protocols. If you look at like DeFi Llama, give or take 50 or more. And a lot of them are sort of based upon similar designs, and they're facing similar problems. And there's sort of what we realize is that there's a lot of constraints when you're building in a fully adversarial environment, right? Like, we know the blockchain trilemma, right? But there's other trilemmas. There's other iron triangles in application design, and we sort of came to realize that, like, lending also has a sort of an iron triangle. So you have these three vertices of, like, you're trying to create something that's fully permissionless, that anybody can list any asset. You want to have it open to anybody, which is going to inherently result in an adversarial environment because bad actors are going to end up participating. And you also sort of need to be able to feed information in that isn't inherently a part of the system. And there's a lot of, we sort of were looking around the space and realized that everybody was sort of facing the same iron triangle, but was sort of facing that information feed in problem, adopting the exact same approach. And everybody sort of, and there's a lot of respect for the other competitors. They've really built incredible things, and there is a lot of innovations, but there's sort of a repeat of using like oracles and governance, right? Like, you need to be able to, and here, let me actually present some information. This will make it slightly easier. But everybody is really trying to everybody's faced with this exact same problem, right? And everybody's faced with the exact same problem, right? We're all trying to get information into the blockchain. We're trying to get a bunch of assets in a lending protocol. We're trying to use those assets as collateral, and we're trying to lend against them. The problem is, on the blockchain itself, we don't know, what that asset's worth. Like, Ethereum itself has no idea what Trump coin is worth. There's really no native way for Trump coin to be priced. You need somebody else to tell you what the price is going to be. You need to write that into a smart contract. You need to have events published. There needs to be some sort of, like, feed, right? And that's just not really natively available. So the obvious solution, and it makes sense why this is the path that we've all gone down, is sort of you have a explicit entity that feeds the price in, right? But we were also realizing, and sort of, I was paying attention to the news, you have an enormous number of attacks on those entities that feed the data in. You have you have, like, people that just straight up are malicious. Chainlink is a reliable source, but other oracles might not be. Even Chainlink might be DDoS attacked. You have potential market manipulation on data feeds. So not all, even if there's a reliable oracle service, the actual underlying pricing source that Chainlink is reporting, or this other oracle source is reporting, might be attacked. And then you might just still get screwed, even over a very short timeline. Like, that's just enough for liquidations. So there's, like, this major oracle problem of feeding data in. And we were trying to, like, okay, so how do we get around that? And then the other problem that we were really facing was governance. So this is a slide I found from a governance study that I read that I think covers a bunch of the main issues. Pretty good job, I think, facing governance. So this is the other aspect of sort of external information in the Iron Triangle. You can only list certain assets when you're depending on external sources, right? Like if you look at how MakerDAO or Compound or Aave operate, there's a whole lot of back and forth. There's risk committees. There's like governance drama to just an insane extent, while people, spend weeks or months debating whether or not to add some new asset as collateral. And if you do add that asset as collateral, what's the interest rate going to be? What loan to value ratio do you allow? Et cetera, right? There's just a lot of questions. And, the permissionless adversarial nature of the blockchain, how do you actually trust, who's saying what? And it just opens there's a lot of cans of worms in the space of trying to onboard new assets. So the sort of what you see is that the long tail of assets is drastically underserved. Even if there's like a highly reliable new protocol that's, it's like the next big thing, it's like serving a real world need, it's adding a ton of value for people, it might not actually be added for 3-5 months and until there's like an ecosystem of services. So this is just really like a major impediment to growth for any individual protocol and just the industry as a whole. So this is like, these are the two problems that we were seeing with the existing designs. This is what we were really trying to solve. So now it comes sort of to like, okay, how do we do this? So it took, to be honest, it took about like 11, maybe 12 design iterations. We sort of spent probably almost a year just in meeting every single day, just sort of going back and forth, trying to find attacks, trying to find edge cases, trying to figure out a way to serve, everybody without putting anybody at risk. And what we realized eventually was that, like actually the users of the protocol have pretty much all the information you need, that you actually can, sort of provide the functions that, that are served by these external providers without having sort of an explicit provider relationship. So basically what we did is we combined Uniswap v3 and Compound to some extent. So we took we basically took a fixed set of price buckets and allowed people to deposit, lenders specifically, to deposit their like, so Ajna is a set of pools. It's a pairing of a given collateral and a given quote. So you could have like gold USD, you could have Bitcoin, WBTC, DAI, you could have WETH DAI, WETH USDC, USDC DAI, any deranged thing you can think of can be thrown in there, as long as it, it meets the ERC specifications for those assets. And we sort of allow people to, specifically the lenders, to come in and say that, like, this is my money, right? This is my asset, and I'm willing to price this other asset at some price. I'm willing to put my money at risk to earn interest. And by doing so, we actually collectively, like, there's like an emergent result that we're able to actually properly.
That's it. What else they want?
Sorry.
Let's go.
Yeah, so there's an emergent result that we were able to actually properly price and sort of derive an interest rate. We're able to derive, like the things that you need to run a lending protocol from the actual lender interactions. So this is sort of an overview of one of the applications that we built. So, or one of our the original partners built. So there's actually like various other front ends. This is ajnafi.com. You can see in the middle here, this is just an example from a current pool, the WBTC DAI pool. You can sort of see what the current lowest utilized price is. And you can see where like DAI is currently deposited, where it's like currently earning interest. There's other, the UI can, as you can, I'll show in the later slides, you can deposit above or below based upon like your risk tolerance, and then you can earn more or less interest. And by doing so, we collectively can actually price any asset, and we can sort of create a market for any asset because we just rely on the lenders themselves to do the pricing. So we sort of, by pushing the responsibility, by pushing the concept complexity of this like external information source problem onto the users of the protocol, and specifically just the lender side, we were able to really sort of service the entire long tail of the assets. So this is a better example of the order book approach we did, basically. So it's sort of simplified. This is from the white paper of Ajna. You can see there's a sort of set of prices. You can see like some, varying quantity. And you can sort of see that like, if you go higher up, you're going to be utilized. You're going to earn more interest the higher you go, because you're putting more of your money at risk. Whereas there's a lot of complexity here, but basically we wanted to also ensure that there was a sufficient buffer. So, if you put it like medium high, you'll still get some interest, but you won't get as much. And if you're pricing things like terribly relative to other people, then you're not going to earn interest until like people are really just desperate to borrow. And one of the interesting things is that when you do this, you can actually sort of, like I was saying before, you can actually sort of build a fully free market for lending, right? Like we don't have any risk committee. We were able to service the entire long tail. We're able to create continuous interest rates that can fluctuate in real time, based upon market demand, based upon risk, based upon lender and borrower tolerances, and it'll just continuously adjust. So so one of the other co-founders is a big math guy, and we put together a couple very elegant equations. It's using some exponential moving averages. If you're interested, I would check out the white paper. But the gist of it is basically, we look at like how the target utilization, which is like a slower moving average, versus like the meaningful utilization, which is like sort of like the current, and then based upon like how the current is going on, like how the current status of the pool, of the pairing of those two assets versus the sort of the longer run of like maybe the last couple of days, last week. It's a little hairy, but like you'll potentially either decrease or increase interest rates. And then every 12 hours, those interest rates can move up or down, and they can just keep moving up or keep moving down pretty much with no cap. So it really depends on user interaction. So like in some of the Ajna pools, we've seen, interest rates over a couple of weeks might spike to 40%. And, we've had some of the community members will be going on Twitter and be like, wow, this is pretty crazy interest rate that you can earn as a lender in, one of these pools. And that's really because, like this is the free market at work, right? It's there's the lenders, where the lenders were willing to put the money, or the amount of lenders that were willing to put their money at those prices just resulted in the interest rates shifting up or down. And then often we've seen interest rates, they went up to 40%, and some long tail asset will then start crashing as borrowers realize that, they can't afford to borrow even against a long tail, meme coin at 30% or something like that. They'll start closing down their positions, and the interest rates will start falling. And so this is the sort of the second aspect to it. So I don't know how familiar everybody is with liquidations, but this is sort of the secret not so secret. The backbone of all lending protocols, secured lending protocols, that you need to be able to liquidate the position, right? Sort of in the name secured, right? Lenders are lending money. They're putting their money at risk, but they are sort of consoled by the sense that they are going to get the collateral, right? Like if that the loan that they're making is backed by the borrower's collateral, that there's always more collateral put down than the size of the loan. So like a lot of different protocols have varying amounts, right? Like Maker was like 125% or something like that. I'm not sure what the latest V3 versions of or V4 of Aave are, but in Ajna we are also over collateralized. We require about 104%, but we're able to sort of get around that because I mean we're still over collateralized, but we have a sort of market driven liquidation system, which is not, we think that having the user driven aspect of it, the ability for lenders to really control how things move, sort of makes it safe in that regard. And also we created a liquidation system to ensure that no matter what, the lenders are also safe. So what we do is we allow anybody to watch the protocol. And if you think that a given borrower position is going to be, is currently under collateralized, or it looks like it's going to be under collateralized based on the way the market's moving, you can place a bond. So unlike other lending protocols where you sort of have like a price feed, you have some set rule about, you need to be under some external source for like at least an hour or more or whatever. This is fully incentivized, fully market driven. Anybody can run like a bot to track this, to predict it, whatever. There's the big thing is basically where you expect people to make a bet, and the bet will either pay off or it'll get marginally slashed in the amount of the payoff, or the slashing will depend on how the auction turns out. And the way we do that is by creating a pay-as-you-go Dutch auction. So this is a diagram of the auction pricing. So we will sort of start the auction at an extremely high price. And the price will be determined by the highest threshold price, neutral price, and reference price. So these are a couple of market parameters. Highest threshold price is basically the highest price borrower, the neutral price being the sort of the price at which this specific borrower created their position, given the amount of collateral they put down and given the like average price of the lenders at the time. So that like we're able to take sort of create some high level parameters and use those to inform where we start the auction. And then we will continuously decrease the auction price and allow external participants to swap in the lent quote token for the debt. And we continuously do that until such a time as the debt has been fully cleared. So the final aspect of the system, and the final aspect of sort of solving for this this no information dependency is that, but there's two sort of things. One additional aspect is that we had to create a lot of fees on certain bad behavior, right? So if you try to rapidly add, if you try to, as a lender, rapidly open a position, close it, open it, close it, open it, close it, like 1,000 times, you could actually start manipulating these parameters. And we were realizing this as we were writing more and more tests, trying to cover all these edge cases, that there's sort of weird things could start happening if you really like start doing things that don't make sense to do as a honest participant, but in the adversarial environment, it can get dangerous. So we had to add a fee there. There's a couple other places we added fees, and unfortunately, when you add fees to things, the money has to go somewhere, right? So you start introducing a potential deadweight loss if you just start charging a fees and you don't either distribute it back to people or you give it to somebody that doesn't actually contribute. It's just lost value. So what we ended up doing was creating the Ajna token, and by distributing it to the community, we can ensure that those fees still can be in place to discourage bad behavior, and that we can actually distribute those fees to honest participants. And the idea being that, with the Ajna token, we'll be able to, keep the protocol going, and just sort of like resolve some of the coordination issues. And part of that was creating, and this is one of the things I talked to Aleem about, a thing called the grant funds, where token holders can, and to sort of get back to the previous uni talk, like we also have a similar 1 billion token supply that's fixed, and that 1 billion token supply can be sort of allocated via, like, a quarter of that token supply is put into a funds that is allocated every quarter to continuous protocols, and it's so that, like, we can ensure that, like, certain needs are met, and also that that there's growth opportunities and such, and that that the token can be really the grant funds can actually like keep it going when we're gone, because as we said in the intro, we sort of we were trying to decentralize, and so we shut down fully. So there's actually, this is sort of the aspect of immutability. We shut down fully, and we're sort of relying on this fund to keep things fully going. We're relying on the fees to prevent bad behavior in the indefinite future, and we're just trying to really just, like, push the responsibility of the system onto the users to ensure that, like, the whole thing can, like, operate without sort of depending on a single entity that could be corrupted potentially. And yeah, that's about it. Happy to answer any questions.
Awesome. Thank you so much, Mike. That was really fascinating. Maybe I'll kick it off with one quick question. I think we only have time for a couple of questions. If you do have a question, maybe raise your hand so I can kind of call you out. I was just curious, like, in terms of, like, the decentralization of Ajna, like, is the code is open source. Anyone can effectively fork it. Anyone can, spin up their own front end to access the protocol. I imagine, yeah, is that true? Like, anyone can kind of spin up their own front end?
Yeah. So we have, so I can share that we have actually 2 different front ends that were created by partners. So we have Summerfi, which is like another Maker spinoff, and then we also have Yearn Finance, and we have Mom, who is like a newer company in the space that built Ajna 5 for us. They're also responsible for the marketing, if you've seen our stuff on Twitter. So if you look at the actual Ajna.finance website, you can see these. Yeah, if you go on the GitHub, everything's completely open source. We've been deployed on 8 L2s currently, or 8 different networks currently. Some of these are just entirely done by random community members. Like, after we launched, like, there's just scripts on GitHub that anybody could just take. You can deploy it on your test network if you want. You can deploy it wherever you want. It's everything is fully open and permissionless.
I feel like this is definitely quite a unique protocol in DeFi. I'm not sure if there's anything else like it. It feels extremely, kind of like community owned and permissionless, and that's really cool. Yeah, I guess being able to host front ends in a more decentralized way, not relying on a centralized infra provider, for example, would be like the next step for a lot of DeFi protocols to really be, truly decentralized, and not to those risks. We'll open it up to others in the group right now. If anyone does want to ask a question, I think we have time for maybe one or two more questions. Feel free to just unmute yourself and ask, or just raise your hand. Okay, Milad.
Hey, thanks very much for all the thing that you do. I want to know about the tokenization that you how distribute your token, and it's go to the developer or some kind of community. How you do the ICO?
Yeah, so there was no ICO. So there's I think the info section here has the exact tokenomics or fact maybe. But basically we the team, the MakerDAO team that was spun off, we self-funded ourselves. So we basically just didn't take a salary for several years and just worked on this. And we took a portion of the token supplies, like around a third, across all the people. So nobody really has that many tokens. We put about like 30% of the tokens into the grant fund, and this is all hand wavy. The exact numbers are going to be slightly different, but not by much. And so we put like around a third of the tokens into the grant funds, around a third went to the team, and then the rest were distributed to some partners like Yearn, like Summerfi, to provide user incentives for the initial launch. So we created so on Summerfi, you can actually get Ajna tokens to borrow and lend on certain pools as controlled by them. Those decisions are pretty much entirely in their hands. There was like a distribution back when the entity was still a thing. Nowadays, it's yeah, the transfer was made, so I have no control over that at this point. It's and then there was like about 5 to 10%, I believe, that was distributed to some VCs.
Cool. Awesome. Thank you, Mike. If anyone has any more questions, Mike, I guess it's pretty late for you right now, right? It's probably close to 2 a.m.
Yeah,
probably gonna be
slowing down a bit.
Get some sleep. Maybe if you want to stay on, I don't know, for like one more minute in case anyone has one more question, you can just put it in the chat. But otherwise, thank you so much. Really appreciate you being here today, and we'll be sharing the recording with our community. And I think this is going to be one of the more interesting talks we've had in a long time. So thank you so much, Mike, for being here today.
Awesome. Yeah, thanks for having me, and happy
Thank
to
you, Mike.
Thank you. Okay, with that, we are going to jump into our next talk because we are a little bit behind schedule. So I'm going to do a quick introduction for Michael Gord, who's with us today. And Michael, we've made you co-host as well, so you'll be able to share your screen if you need to. I'll do a quick intro. So Michael Gord is the co-founder and CEO of GDA Group of Companies. It includes GDA Capital, focused on digital asset investments and Web3 capital market advisory; Acronym Asset Management, focused on market neutral asset management strategies; NFT Basel; BAZL, focused on investment grade NFTs; and Life DeFi, focused on making DeFi accessible for retail investors. He is going to be focusing his talk on Life DeFi today. We're really excited. So Michael, without further ado, off to you. Thank you for being here. I think you're, oh, okay, you're unmuted now. Okay, perfect.
Can you see my screen?
Yep, we can see.
Yes.
Also, get rid of this background. 1 sec. Is it This is probably better. Hey everyone. So, yeah, gonna be talking about network effects and the mainstream adoption of digital assets. Gonna go through a brief history on network effects, talk about network effects, talk about some trends and opportunities that I'm excited about in DeFi. I'm gonna give a bit of background on life. As was just mentioned, I'm a serial entrepreneur and investor. I've been focused on the mainstream adoption of digital assets since 2013, went down the rabbit hole in 2011, been building businesses in the space since university, but full time since graduating in 2016. Have a number of exits, have a portfolio of about 70 companies we've invested into, and yeah, it's been fun. So just to go into bit of background on network effects. Can't see the audience here, but if you look at this picture, it's a picture of Fifth Avenue in New York City in 1900, and it is just about impossible to find a car. 13 years later, same street, and it is impossible to find a horse, pretty much. So in 13 years, cars were so disruptive that it went from being virtually all horses to virtually all cars. See, there's the car, there's the horse. Can't even really see it. As technology has gotten more adopted, the curve of disruptive technology growth happens faster. So this is a picture of a concert prior to 2015, picture of a concert after 2015. And it's only getting faster. So prior to the internet, prior to social, would have taken decades for disruptive technology like the telephone or TV to be adopted internationally. Whereas now companies are onboarding millions of users almost overnight. It's pretty crazy, actually. So if we think about network effects, it's the square of the number of people in the network. And we think about digital assets and blockchain technology, the more people that enter these networks, the more valuable the network becomes. A interesting story that was shared with me many years ago, I'm happy to share with the audience here, is the creation of the chessboard when considering squares and networks. The person that created the chessboard was offered by the king at the time what they wanted as a reward for the creation of chess. And what the founder of the chessboard suggested is that they just want to get 1 grain of rice on the first square, and every day afterwards they want to get twice as many grains of rice. So the second second square of the chessboard had 2 grains of rice, the third had 4, then 8. And the first half of the chessboard, the piles got big, but we're still reasonably modest in size. But the way that networks work and the way that doubling works is that by the second half of the chessboard, the amount of rice put onto each square got so immense that the final square would have been a pile of rice larger than Mount Everest. The king realized that he was duped, ended up killing the founder of the chessboard, allegedly, which is a kind of interesting story, I think, when considering doubling. And as we spoke about, network effects are getting faster. So it used to be the case that things would take decades to reach hundreds of millions of users. ChatGPT was able to reach 100 million users in 2 months. One thing that I'm excited about with disruptive technology is Pixelverse and the Telegram ecosystem, the Ton blockchain, because they already have hundreds of millions of users that you're able to onboard users super quickly. Pixelverse is a portfolio company of ours. They got 50 million users in June. They're now up to 75 million users halfway into July, and it is the fastest company, a little bit less disruptive than ChatGPT, so less talked about, but is the fastest company in the world to reach 1 million users, fastest company to reach 10 million users, and I think is likely to be the fastest company in the world to reach 100 million users, which is pretty crazy. Some other trends and opportunities that I'm seeing in decentralized finance. These are all portfolio companies of ours. We're invested and active in all these companies. Is Alvaro Protocol, which is the creator of the ERC 7621 token standard, which allows for a token to represent a basket of assets, kind of like a REIT or like an ETF. So you can have an arbitrary portfolio of tokens. You could have one token representing, for example, 50% Bitcoin, 50% Ethereum. You could have a token representing 10% of each top 10 cryptos. And anything and everything. So there could be tokens representing baskets of real-world assets, baskets of launchpad assets, baskets of protocols, baskets of mid caps, low caps, blue chips, NFTs, metaverse, anything and everything. So the barriers to enter and to create essentially a fund is now tokenized. So super excited about this trend. Another is continuing with the Telegram thesis is Flashy, which is creating super dApp on Telegram. So you'll be able to have arbitrary banking functionality directly in Telegram. Life, which is wholly owned by us, or I guess we acquired it, and it's not wholly owned anymore. We raised a buck, but it's live on the Apple and Chrome and Android store. It's actually just being redesigned, so we're pushing an entire new product. The objective initially was to create an app with all decentralized finance functionality. So now we've got a lot of decentralized finance functionality. The update that we're pushing is gamifying everything. So making it so that users are earning rewards for using the application. The more friends they invite, the more they swap, the more they stake, the more they interact with decentralized finance, the more that they will earn in the form of airdrops and in the form of giveaways that we will be providing. So super excited about that. We are also providing this as decentralized finance as a service infrastructure to primarily social networks initially that can turn a social network, which originally is a difficult business to generate revenue from, and definitely to generate multiple streams of revenue from, to make any social network, for example, into a digital bank, so that users of social networks can also swap or lend or stake or anything. Yeah, bit more screens and thoughts on the gamification. So yeah, the idea is that people level up based on the amount of use that they do. By leveling up, they earn larger shares of airdrops and giveaways, essentially making it much more profitable than, for example, a MetaMask or, for example, a TD savings account. So we're excited about this product. A little bit more about us. Diversified across the capital market, teams all over the world, and numbers kind of speak for themselves as far as our track record in the market. Team also, spoke about myself. Basically, all of us have a number of exits, have been advisors to family offices, international accelerators, have taken companies to market, have taken digital assets to market up to in the hundreds of millions of dollars of market capitalization. Yeah, pretty focused on creating adoption in digital assets. And yeah, that is a bit about me and us and life and what we're excited about DeFi. So yeah, if anyone has any questions, happy to take some questions.
Awesome. Thank you so much, Michael. Appreciate the presentation, and really interesting to learn about GDA Group and Live DeFi in general. And it was an interesting talk on network effects as well. So thank you for that. Yeah, we'll open it up for some questions.
Hi, Michael. Who do you consider as your competitor?
For which business?
Live DeFi.
I would say you could consider MetaMask or crypto.com to be competitors. Yeah, MetaMask or crypto.com. I mean, they're quite a bit bigger than us. So I think the gamification element is super new. And also because MetaMask and crypto.com are so big today, they're not providing their software as infrastructure as a service, whereas rather than us look to acquire users one at a time, I would be happy and we are providing our software as a service to turn existing social networks or existing games into digital banks, essentially. Whereas which social networks or games can earn income from the transactions that occur in the digital banking, decentralized financial experiences that occur in app. Whereas a MetaMask or crypto.com would want them to, to be on MetaMask or crypto.com infrastructure. But yeah, I would say still that those are probably our biggest competitors, but we're a rounding error to their size and scale today. So and a different go to market, but yeah, similar business model.
Thanks. I think Mo, do you have a question?
Hi, Michael. Yes, thanks for the presentation. I was just wondering, what's the size you invest? Is pre-seed, seed, and which sector you are excited to see the growth? Is it GameFi or it's a DeFi? Which sector you're really your venture capital is very interested in investing?
Pre-seed, seed primarily. We've done a bit of Series A, but we want to be really early and active. Most of the deals we've done in the past year have been sub 10 market cap. 5 to 50 is our sweet spot, but yeah, most recently we've been increasingly early, and we're very active capital, so we don't just invest and then disappear. We want to have active participation with aligned incentives for our participation with the founders. So fit in our ecosystem, businesses that we think we can directly contribute to from our experience, relationships, and access in the market is a fit for us. And yeah, we're pretty diversified across the digital asset capital market. Infrastructure is always hot. I think decentralized DePIN is hot today. Recently we've done a lot of gaming stuff, a lot of AI stuff. But yeah, we're pretty opportunistic. Yeah, we're pretty opportunistic. We have no LPs. So yeah, really businesses that we think either fit in our portfolio or that we think we can directly add value to from our experience, relationships, and access in the market.
Is it equity or just token?
We've done some equity, we've done some private equity, we've done some public equity, but pretty focused on tokens. We just play with our own capital, and especially private equity has really uncertain timelines for liquidity, which doesn't really work for us. But unless there's a hyper strategic reason for us to be in equity. But yeah, in general, as mentioned, we're opportunistic. So
thanks. Love to connect. Thanks.
Awesome. Okay. Any other last questions? Maybe one more. Sharon?
Hi, thank you. Thank you for that. I have a question for Michael. For the Family Office Network, GDA Wealth, right? What's your view on the opportunity to invest in crypto investment from the current generation wealth transfer era? Like, what's your view on that? What's the appetite from the Family Office Wealth Network?
Slow and then all at once.
Okay.
And yeah, families are for the most part not participating in risk capital. So I think you could think about it as with each family, slow and then all at once, or you could think about family offices in general, slow and then all at once. It has been very slow, like trickles of families dipping their toes, but
what kind of methods or educational series do you think it will be helpful to increase the adoption for the generation, the wealth transfer for the next generation?
I think a big part of it is who runs the family office. Is it a 60-year-old or is it a 30-year-old? How much decision-making power does the 30-year-old have in the family, or how much decision-making power does do they listen to the 30-year-old, to the kids, grandkids? How did the family make their money? Did they do it from venture? Did they do it from real estate, or how did they make their money?
So and also from when you position the crypto investment, when you sell this idea to the family office or the next generation, do you position them as more from a liquid venture type of crypto investment, or more from a real asset, act as a hedge to inflation, that type of investment?
With
Hi.
Hey.
I'm talking to myself. You're not having your kid want me to bring a piece of birthday cake?
For the most part, I'm not trying to sell anything, I'm more trying to educate, and depending on what the investment appetite is, or what the depending on what the appetite is, then I'm happy to share opportunities. But yeah, I'm not really trying to sell things.
Thank you.
Thanks so much. All right, cool. I think we're going to jump into just like close things off with some community announcements. Michael, thank you again so much for being here today. I know Mark wasn't able to be here, but he's very appreciative of your presence as well. So thanks so much for the talk.
Thanks, Alan. Thanks, everyone.
Cheers. We'll do some quick community announcements. So if anyone has anything they want to share, maybe they're fundraising, maybe they're looking for co-founders, maybe they're working on a new project, or maybe it's some new research in DeFi, feel free to kind of speak up and tell us what's going on. And we got a couple of minutes for that. You can raise your hand if
yeah, for DeFi Toronto, we're gonna have a panel at the Futures Conference next month. So our topic will be related to how to generate yield or fixed income on the crypto space. So please come to join us during the Futures Conference.
Yeah, that should be exciting. So that's going to be combined with ETH Toronto around second week of August, I believe.
Yes.
Pretty good. Mario, what's up?
Hello. Thank you for having me. Really like the work you're doing. I just want to first say thank you because I won one of your giveaways for the Untraceable event.
Oh, nice.
So I applied for the ticket and I won, so I want to definitely say I appreciate it. Also, I'm doing a community-based agriculture for a blockchain/crypto startup. We're operating in the DePIN space. And obviously we turn digital assets such as real world assets, such as like corn, maize, soybeans into a digital twin, so a digital version. We're looking to gamify that, and we're looking to raise capital and all that stuff. So we're definitely looking for assistance or grants or anything to see basically what's available. Thank you.
Awesome. Thanks, Mario. Appreciate
Yeah.
it. And if you're enjoying the DeFi Toronto TG chat, feel free to join. I think Victor put the link in there. And there's definitely some angels and some VCs in that chat as well.
Thank you.
Awesome. Thanks. Thank you. Thank you, Mario. Anyone else? Well, maybe time for one more. All right. Sweet. Victor, do you want to say any last words before we close off for this meetup?
Thank you for everyone for attending. And next month, we're going to have an in-person meetup on August 8th. So please come to join us again. And we always look for speakers, especially for in-person event. We'd like to find the local speakers. So if you know any startup developers that fit our mission, in particular related to DeFi, please reach out to us and let us know. We always appreciate. Otherwise, we're going to see you. Hopefully, see you on August 8th.
Yep. Thanks so much, everyone. Well, looking forward to seeing you if you're in Toronto on August 8th in person. And enjoy the rest of your evening. Thanks so much for joining us.
Thank you. Bye.